On today's episode of the Stock Market Playbook, we have Emir from TypeF Capital. I think the key takeaway today is you got to put in the work. Emir talks about some of the example trades that he has been in and that he currently is in, and his process to why he doesn't panic when a stock drops a lot and why maybe he's buying more. I think you're going to love this episode today. Enjoy this episode of the Stock Market Playbook with Emir. Okay, we're happy to have Emir from TypeF Capital with us today. We got some good stuff to talk about. We were chatting a little bit before the recording got started, and I think we're going to have some pretty interesting points of view to discuss. But first, just tell our viewers, tell our guests a little bit about yourself. Where'd you come from? How did you arrive to do what you're doing right now in the type of market research that you do?
Yeah, sure. And happy to be here. Well, I don't have like this whole crazy, interesting story. It's more rooted in, always being competitive throughout my whole life. And as a young adult, I viewed it as, well, the global financial markets is perhaps the largest scale battleground in the world. So I just carried over that competitiveness that I've had my whole life towards, the equity markets. And I've always been kind of obsessive about anything I'm interested in. So I would learn everything there is to learn about whatever I'm interested in. And it just so happened that I picked up an interest in, equity research, and in particular companies that have a fortress-like characteristic to them. And, discovered Aswata Modran early on, started caring a lot about intrinsic value. So I think it's a space, a niche in today's markets where there aren't too many people caring about intrinsic value anymore. It's more about pricing, taking shortcuts. So I thought that, well, there might be value to provide to others by actually starting to publish now I publish on Substack primarily about, these kind of companies and anchoring it to intrinsic value. So that's really the short version of it. He had an interesting quote. I don't know if people will be offended, but he said something along the lines of people like to masquerade as caring about the growth, cash flows, and risk, but in reality, it's all about mood, momentum, and what is everyone else buying. So I was always like, oh, that kind of hits hard, so I've been on the, only caring about intrinsic value for however long I've been going. So
that's great. That's great. And I think there's first of all, every guest we have on this show has such a different point of view of how they approach the markets, which I love. That is the entire purpose of this podcast, is to share points of view and how you approach markets and how you approach your analysis. And so I think we're going to have a great discussion. Now, before we get there, for whatever reason, I'm always interested where people have been, where they come from. You mentioned you grew up in Sweden and now live in Japan?
As of December, yeah. So I just recently moved out, and there is no interesting story attached to it. It's just that my wife is Japanese. We have a daughter now, and I don't have a big family in general. So whenever holidays come around, there isn't a big gathering. I don't have my daughter now doesn't have cousins to play with and stuff like that, but they do have that in Japan. So my wife's family is larger. So, it's a great society here, it's safe, it's great. So we thought we have this opportunity, so why not move out to Japan? So as of December 2025, so a few months ago now, I moved out permanently to Japan, and it's been great.
Wow. So this was a pretty recent move. Now, how is your Japanese?
It is not great. And it is rough because people may not be aware. If you come to Sweden, if you're internationally traveling to Sweden, you'll be fine. Everyone speaks English, everyone, almost natively. And some people would say better than natively for some people. when you come to Japan, no one speaks English. Like, you are on your own. Like, you better brush up on that Japanese. And mine is fine for understanding. Like, okay, just a quick story. So my daughter, they moved out 3 months before me. So somewhere in like August, September, and I came in this December, right? My daughter is now 3 years old. They moved out 3 months earlier. During that time, my daughter only speaks Japanese after living in Sweden and only speaking Swedish prior to that. So I come here, and it is a strange feeling not being able to understand what your daughter is talking to you. Like, I don't know if anyone has ever experienced that. Like, you can't communicate with your daughter because she speaks another language suddenly. Luckily, I've grown to understand a lot of Japanese, and she still understands Swedish. She just refuses to speak Swedish. I'm like, can you tell me in Swedish? I don't understand. And she like will get frustrated. Like, how come he doesn't understand me? But yeah, I mean,
How fun.
it's a struggle, but
It, that is a great story. I had a friend of mine forever ago that his mom was from South or his well yes his mom was from South America and his grandma, but his mom spoke English and his grandma did not speak English, and he in his adulthood learned Spanish, and he said, oh my gosh, I can talk to my grandma now, like at 25, whereas his whole life he'd never been able to talk to his grandma. So that's the closest I've heard. But to not be able to communicate with your daughter, that would be quite an experience. Oh, interesting. Well,
yeah.
Japan is a super cool place. I've spent a little bit of time there. Sweden is also wonderful. Sweden is super interesting because just like you said, I mean, so many of those Nordic countries speak English along with their language, right? They're, whichever country.
Yeah.
And I remember, the first time I went to Sweden and I went to buy something in like a store or something, and they just started speaking Swedish to me, and I didn't speak one word. And I said, oh, do you speak English? And then, of course, this girl starts talking back to me in perfect English with no accent. And I was like, my brain is bending. You speak perfect Swedish and perfect English. And so anyways, both great places. I love them. So I hope you're having a good experience in Japan. Also a beautiful country.
Yeah, it's great.
So when you talk intrinsic value, I do a lot of option trading, and we really love the intrinsic side of things and options. But intrinsic value, I think, is something really overlooked. That's kind of it's obviously very important. It's kind of Warren Buffett-esque, right? He's a real intrinsic. What is the real value of this company, or what should it be? And overpriced and underpriced. On that intrinsic side of things. Is that kind of how you approach it? Tell us a little more about your take.
I mean, it is not really stock market related at all. Like, the term has been around for over 400 years. You used to have Venetian glass makers buying and selling businesses based on the projected cash flows of that business back in the 1600s. So it is not a new concept, and there are multiple ways to go about assessing fair intrinsic value. What most listeners will be familiar with is probably a discounted cash flow model, free cash flow to the firm, free cash flow to equity, that kind of thing. I don't think Warren Buffett necessarily ever employed such a model when assessing the value of a business. It just goes to show you that there are multiple ways to go about it, but the core idea is that you look at growth, cash flows, and the risk associated with acquiring those cash flows that you're projecting out. So that's really the core concept of it all. And the thing with today's markets, why most people don't really do that work, even in a professional setting, so is that it takes a lot of time, a lot of effort, a lot of time. You need to understand the business. So when people think like a DCF model, for example, they'll be like, oh, just put 10% revenue growth for the next 5-10 years, and then put this margin, and I get a value. Like, no, that's an Excel exercise. That's not a valuation. So you really need to tie together the narrative for the business and put that into numbers. So really a valuation is just your understanding of a business put into numbers. So whenever you point to a number like in year 5 of a forecast, you need to be able to tell me, okay, why is that number there? And the answer better not be, well, that's the trend. Like no, it has to have a reason for being there. And to do that, it takes a lot of time, a lot of effort. And imagine being you're at a hedge fund. Let's say that you have like 40, 50, 60, businesses in a portfolio. You don't have time to have such a deep understanding of 60 businesses that you keep valuing them. So what most people do is that, even in a professional setting, they will talk about the valuation of this business, but what they're really talking about is the pricing, because they will use a shortcut, a PE ratio, a price to sales ratio, which is pricing. It's not tied to the value of the business, more so the pricing, and it used as a comparable to other businesses within that same sector. Like, oh well, this valuation of a PE of 20-30 is expensive or cheap, or it isn't really related to value, because most people don't actually talk about actual intrinsic valuation in the same concept. But I just thought that there was a niche there and an edge. When I was young, I was like, well, a lot of people are not really caring about this. And the market, you can call it a weighing machine, a voting machine. Over time, it tends to aggregate towards intrinsic value, the quote of a stock. But it's really like only a reflection of your understanding, as I mentioned. So your understanding of a business can be completely wrong, or it can be completely accurate. It isn't necessarily tied to what the market will be doing in the short term, in terms of a stock quote. So it's really about being able to put capital to work and sleeping well. Like, there have been times in the stock market where I've been heavily concentrated in a single position. I've sold off all my positions and went all into one stock, and I've done great. I slept well throughout it, because I felt that I did the work necessary to be able to sleep well holding a single company, because I thought the opportunity was so big. I was like, no, the market is completely missing something here. And that stock in particular, maybe some viewers will be familiar with it, was Palantir Technologies. And this was when Palantir was trading, in the single digits. So I did an intrinsic valuation on the business, and I'm like, the current stock quote of like $7 only incorporates, the government business, and I'm getting the whole commercial business for free at the time. And this was before Palantir had this exponential growth, before Palantir had this margin expansion, before they had their AIP platform, everything that enabled the acceleration. So when I did the work, I'm like, oh, something is wrong here. Like, the market is misunderstanding this. And because I did the work, I was comfortable just holding one position. I'm like, well, it's a rare opportunity, so I don't mind concentrating. And then as it caught up with its valuation, I of course started buying up other great businesses as well. But just having that opportunity to be comfortable and sleeping well because you did the work, I really value that a lot as an investor. So it really, the way to view it is that an intrinsic valuation only has an audience of one, and that is yourself, because everyone's valuation of a business will be different, because everyone's understanding of a business will vary. So it's kind of
so that brings up two questions, and I would say question number one is, if you are valuing a business like that and you're going, say, with the intrinsic value based on whatever model of choice, right?
right. Yeah, they should all be the same if done correctly. So like the
yes,
value
yeah.
should be the same, no matter what kind of model you do. Yeah.
So I mean, the typical argument on that fundamental basis is, in the long term, real fundamental analysis wins, right? If you, even if you almost incorrectly value, but if you're in the ballpark, if you're close enough, then in the long term, your company, your business, your valuation is going to reach that area that you're targeting. So what about if you're heavily concentrated? Um, the short term can be a bit of a wild ride. So how do you kind of manage and justify that short term move? Like say with like a Palantir, for example, obviously buying Palantir in single digit prices, is amazing. The stock has gone up like crazy, so that's a great trade. But in the short term, um, there can be a lot of volatility. There can be a lot of changes and uncertainty, and certainly with stocks that are already undervalued. Right, in the long run, something that's undervalued now, we know in the long run it will reach its valuation, or it'll reach its actual value. But the short term, cheap can always get cheaper. So how do you manage that short term?
Yeah, so using Palantir as an example, at the time, the business was actually decelerating. The growth was going down to, I mean, at the lowest, they went public. They had, 30% growth. The management said that, well, this business is going to compound at 30% per year for the next 5 years. That started to become, 25%, 20%, as low as 12% year-over-year growth. And people are looking at it like, oh my God, what's wrong here? And then they pulled that, 30% CAGR guidance. There's a lot of questions, but for those that did the work, and saw past that, of course, they were rewarded. But at the time, it's very difficult, to be invested in a stock that is decelerating. The stock quote is getting hit hard. And the way to view it is, oh, well, I can only speak from my personal how I go about it is that I don't even look at stock quotes. Like the only time I look at a stock quote is after I value a business, just to get a reference of, okay, where is it currently trading? Because to me, this company is worth this much. Where is it currently trading? Just to get the reference, is it under or overvalued? But I don't track, day-to-day charts. I never look at a chart at all. So you kind of get numb to, the day-to-day or even week by week, price movements in stocks, because I simply don't look at it. I don't, look at my portfolio every day, every week. Sometimes not even monthly. I just focus on doing the work and then letting the companies, play out the thesis, hopefully. And
Yeah.
then I check in, was I wrong? Did I miss something? Is there something new? So that's another thing with, intrinsic valuation, is that you need to keep revaluing businesses every time you're given a reason to. Now, typically that is once a quarter when you learn, more about the business, but it could be, a press release that changes, everything, and then you have to value it again. So there is a lot of volatility in intrinsic value itself. But the way I deal with the volatility is that, well, I barely notice that there is any, because I don't check every day. I don't look at stock charts. I don't pull up the price. I don't look at my portfolio obsessively. I rather spend that time, studying the next business, So that's really the way
What
I deal with it.
what is a what is a heavy position for you? Is that 10% of your portfolio,
Oh, no,
5%,
no.
20%?
Well, some people might have felt it in their own portfolio as of late. There's been a huge sell-off in a bunch of names, tied to AI fears. We're having geopolitical conflicts. So at this time, a lot of high quality businesses and the kind of fortress like business that I really specialize myself in are very sold off. So at the time, I'm fully invested and I only have 4 positions now. And my largest one is over 50% now. And I don't mind, So during regular times, I would hold something like, 8 to 10, very concentrated portfolio in general. But at the time, it is now 4. And none is smaller than 10%, because the way I always viewed my own personal portfolio is that, less than 5%, like even if you are massively correct, let's say that a stock, doubles, like it's not really moving the needle. So the only time I would consider, diversifying more is if I was very, very wealthy. If I had a large portfolio where it more becomes about, protecting capital than growing capital, then I would consider, having positions that are smaller than 5%. But in general, I'm like, no, I did all of this work. I see a great opportunity here. Why would I only allocate, 5% towards that opportunity? Because, there are thousands and thousands of publicly traded companies. I identified, the one that has, high barriers to entry, is completely dominant, deeply embedded in its industry. Why should I only, if I made a decision to invest in this company, why would it only be, 5% or less? So I'm typically very, very concentrated in my approach.
Interesting. What how does your process go? I mean, what gets you down? You obviously can't run valuation models on every
Yeah,
company out
exactly.
there. So how do you kind of what's the top of the funnel look like? How do you start to look at the stocks and companies that you like to start digging in deeper?
Well, that's a good question. And if there was an easy answer, I would be finding, these amazing stocks every day. But no, it's actually, I've never really thought about how it happens. I guess the answer is something like, typically when you are surrounding yourself with discussions, surrounding the public markets, you hear about a company, you typically hear, a short thesis of why this company is interesting, and then you might, take a look briefly, and when you see something that really interests you, that's when you dig deeper. So for me, I know that some industries are completely unfair in general. Let's take the credit rating business, for example. It's a good example. So let's take something like FICO, right, or S&P Global, Moody's. All of these three,
Sure.
they operate, credit rating business in one form or another. All three of them have amazing operating margins. I think FICO 88% operating margins on the scores business. It is completely unfair. So I'm like, okay, well, how does this happen? And then I look into FICO. I'm like, okay, they have a 95 to 99% market share. Competitors give away their service for free and still can't displace FICO. No one is switching over, even though Vantage Score is being given away for free. So, okay, they can't be outcompeted. Why is that? Well, because there are regulatory implications. So a bank would have to re-rate all of their portfolios if they were to switch from FICO to Vantage Score, for example. Trying to sell a mortgage derivative, oh, our portfolio here that we're trying to sell you is based on Vantage Score. That doesn't translate. Like it's like we said, not understanding your daughter. It's like speaking a completely different language. When a whole system is built on FICO, and people only speak FICO, you can't just pick it up and displace it. And then I see like, okay, their pricing power, they increased the cost of pulling a FICO score 725% over the past few years. And in this, recent months, they found a way to increase that by another, 800%. So I'm like, oh my God, this is, an amazing business. They can't be outcompeted. Like they are protected by, regulatory concerns, like just all of these things aggregating. So I'm like, okay, the scores business is very strong for FICO. How about, S&P Global? And then you see that, 76% of, all the credit rating volume in the world goes through S&P Global. And then you're like, okay, I'm starting to get it now. So it's more about, finding these unfair business models, looking what companies operate within those, identifying, okay, how defensible is that dynamic and stuff like that. But yeah, I mean, I wish I could find a new, opportunity every week, but it's really rare to find these kind of businesses. And that's also probably why my portfolio tends to be very, very concentrated, because finding these businesses is rare. Another rarity is finding them trading undervalued. These kind of
Sure.
businesses that are, I like to call them, I used to call them like mafia, like really oppressive, like kind of businesses that everyone has to adapt to, like high barrier to entry, high quality kind of businesses, they typically tend to trade overvalued because the market has identified that these are like the best businesses in the world, right? Um, and with the recent sell-off, I mean, there's a lot of opportunities in these names. So I'm like, okay, I'm going to go completely concentrated and use this opportunity because it doesn't come around often. I
Sure.
looked at FICO, 2 years ago for the first time. I'm like, amazing business, but I can't buy it. Like, it is trading super overvalued. So it's a lot about being patient. Even after you identify a business, most of the time you can't just go out and buy it because, well, the market also, identify that this is a good business. But um,
Yeah.
things
Do you,
happen
so
and
do you,
reward a patient investor.
yeah, no, that's I mean, the patience game in the stock market is also very underemphasized, underutilized, waiting for a good opportunity, right? I mean, because again, there's so many people on both sides of this. There's people that are taking 200 trades a day, 500 trades a day, and then there's people that are taking, making 5 investments a year, right? And so there's such a span there. Do you ever just find yourself like, you know what? I'm going to look at big names I've heard of and find stuff that's just murdered. I mean, for example, I've got some charts up over here. I don't own any of this. I'm not trading any of this, but like I look at Lulu and I say maybe at some point I'm going to look a little more into Lulu, or I look at PayPal. Maybe I'm going to look a little more into PayPal at some point and find out, this big name with this big brand, is there any love there? Or, I mean, do you ever do anything like that? Like, hey, this is a stock that has been murdered. Is it fairly or unfairly 50, 60, 70% off its highs?
Yeah, so that's another way to discover, get businesses into your attention. Let's talk about PayPal, for example, right? So I had a look at PayPal, and on paper, prior to the Q4 results, I don't know if you're into PayPal at all. I can just tell you briefly that I was like, okay, they have grown market share from 2010s throughout 2022. It started to drop down briefly. The fear at the time was that, well, they're being outcompeted by Stripe, Adyen, Apple Pay, Google Pay, all of these different payment methods and payment service providers. I'm like, well, all of those competitors have been around, for more than 10 years. So this is not something new. So why is the company selling off? Well, the take rate is going down. Well, it's going down for all the competitors. It is basically a race to the bottom. When you're a payment service provider, you differentiate yourself by being cheaper than the next competitor. So I was like, okay, well, I don't really buy that fear. And then I look at the company, I see like, well, about 25% of all e-commerce goes through PayPal. So what most people at the time associated with PayPal is like a pay with PayPal button, or that you log into paypal.com and then you transfer money to someone else with the PayPal account. But no, the people miss that. Even if there's no pay with PayPal button, if you made an online transaction, it was probably powered by PayPal, statistically, since they are the largest player, just the back end. So I was like, okay, so they have this huge data moat. They're talking about starting an ads business. I'm like, okay, well, what better company to serve ads than one that knows exactly what you buy and when, and from where. So everything was like set up to be great for PayPal. They had the ads business. When this whole AI revolution started coming around, there was one payment service provider, being PayPal, that started to partner up with OpenAI, Anthropic. They started to partner up with MasterCard, to do agentic sales within these different LLM applications, be it ChatGPT, be it whatever. So like, well, this is probably the future of commerce, because as I moved to Japan, I had to buy like furniture, and I'm like, I have no idea, like, what should I look for when I buy a refrigerator? What should I look for? So I started to use LLMs to do the research. I'm like, it would be so convenient, just to buy it within this chat context. So everything was really set up great for PayPal. And then they fired their CEO in Q4. everything collapsed. The timelines are being stretched out. They're not really executing on the opportunity. So in PayPal in particular, there was a lost opportunity. They had a lot going for them, but they have simply not been uh, executing. And when I did the valuation on PayPal, I didn't include an ads business because it was not material, right? So I didn't do any projections for all of these immaterial things. Only based on what they had at the time, PayPal was very undervalued. I'm talking like over 100%, to reach fair value. Let's say that it was trading at 70. I was like, well, it's probably worth 140. So I put some capital to work there. But I identified early on that this is not really a high quality business. It's not the kind of company that I would typically hold, right? It's not really part of my whole investment philosophy. But I just felt that the opportunity is there. They are still, dominant in their market. 33% of all credit cards in circulation have gone through PayPal. Like, just a number like that is just so massive. Like, okay, well, they have this whole data moat that they just need to execute. Well, for 2.5 years, they have not been executing. They fired the CEO. They're getting a new one now. The company is bloated. So the market saw something that I didn't see. And, I've cut my intrinsic value for the company in half. I'm like, well, I can't hold this company anymore because I misunderstood it. Like, I obviously don't understand the company well enough to value it accurately. As you mentioned earlier, like, you just have to be directionally correct most of the time, with the caveat that is if it's a high quality business. Like, a high quality business will execute towards that path that you see. But when it's in like a low quality business like PayPal, being directionally wrong can be really hurtful for your portfolio. So
Sure.
it's a trade-off. I tend not to dig deep into that deep value basket just because well, this company is cheap. Well, I need that quality aspect, and I learned that the hard way with PayPal in particular, because on the surface level they had all the opportunities in the world, but they just not been executing.
So what signifies, like, what checks the box for you to say a company is a quality company or not a quality company? What are some of those aspects you look for?
Well, that's a good question because it will vary depending on the industry and sector. So I'm not really tied to, I only invest in tech, or I only invest in financial companies. So I'm really open to anything. But a lot of people love to say that, well, I want a high quality, high growth company. And as you mentioned, like, well, what does that look like? Well, you need to be able to have the operating margins that signify that you have some kind of barrier to entry, like as we talked about with FICO and the credit rating businesses. 80% plus operating margins, that is only explained by there are high barriers to entry, like this is difficult to displace. Or you would have something like with PayPal where the margins are disintegrating because it's being outcompeted, right? So you have to look for barriers to entry is what I really care about. I like to see that pricing power. I like to see high margins, obviously. Let's take S&P Global's indice business, for example. People might be familiar with the S&P 500, for example. That business has something like a 90% operating margin. That is completely insane, like one of the highest that I've ever seen. And it is growing fast as well. People are going more and more towards passive investing. So it really varies industry to industry. But what I have identified time and time again is just that barrier to entry kind of quality or property to businesses that really signify that they are special and they won't easily be displaced. And then you just have to see all the evidence of that barrier to entry, like pricing power, margin expansion, and the opportunity for growth and stuff like that. But there's not really, like, you can't just put it in stock screener, like, well, if the operating margins are this and they're growing at this rate and it should be a high quality business. Like, no, you have to dig deeper than that. But there's no simple answer to it. Unfortunately, I wish it was simple and that I would be finding these companies every day, but
Sure.
that's just not the reality of it.
No, that's great. What is a typical holding period for you? How long are you trying to stay with these positions? Is it more Is it more valuation target, or is there kind of a time you are okay with? You don't like to exceed?
No, well, it's funny that you mentioned. I think the average holding period for equities has been going down for 15 years straight. I think the average now for U.S. equities is something like 6 to 8 months, and this used to be years. So there's a lot of trading being, people are moving more towards trading. For me personally, I rather not sell at all if I've identified and managed to buy a company of this kind. I rather not sell them, just let them compound. But the thing is that we will have periods like the one that we're in right now where everything is selling off. And when you hold these kind of high quality businesses, they tend to sell off a lot less than more volatile names. So let's take something like Robinhood Markets, for example. A high quality business, they are executing, but extremely volatile, right? So it sold off, it was cut in half. And then you have some very low beta companies in your portfolio where you might be overweight because it has been performing so well, it has been compounding so well, but it might be more towards that fair or even overvalued territory. And then you have another high quality business that you've been tracking sell off completely. Then I would rebalance. So it's nice to have a company like S&P Global. Historically it doesn't move a lot, it just sits there and compounds. And then you have some great opportunity like Robinhood last April sold off to something like $25-30, and then my S&P Global hadn't moved at all. So I sold some S&P Global, these defensive positions kind of, to buy the more volatile ones that might be of equivalent quality. And then Robinhood shot up to 150 from that 30. So in hindsight, sure, it was great, but it's not about wanting to trade around a lot. It's more like, well, there's an opportunity now, but I don't buy a position with the intention to, well, I'm gonna sell it as soon as it reaches fair value, or if it goes slightly over value. I go into a position thinking that I'm fine holding this forever, basically just letting it compound. But then things happen in the market where you have to be opportunistic. Like, you have to take advantage of the opportunities that you're given. So I might sell off some positions to concentrate into the biggest opportunities at times of extreme fear, like we're seeing right now, or April of last year, or during the COVID sell-off. So during those extreme times, I might consolidate, but in general, I don't think about, when am I gonna sell this position. In general, I'm just happy being in them for managing to buy them under fair intrinsic value, and that is rare when you solely focus on this kind of business. So it's the way I go about it.
Yeah, that makes sense. What, I mean, you don't have to give away your secret sauce, but what are a couple of favorite stocks you're watching right now that kind of really fit into that valuation model that you like?
I think well, we talked about, I think FICO is unjustly being punished now. It really started with the I forgot the agency name, the FDHA, the Federal Housing Agency went after FICO, saying that, well, they are exercising too much pricing power. We need to introduce some competition here. Well, as I mentioned, you introduced the competition of Vantage Score, but no one is switching over anyway. So like the moat is still there, but the market sold off FICO on that. So I think FICO is a great opportunity. Well, let me just explain quickly that they tried to blame FICO for high housing costs and like saying like people can't own houses because FICO scores are too large. I'm like, hold on a minute. A FICO score at the time, a FICO score pool costs $5. Is that really the reason that people aren't owning homes? Like what about the thousands and thousands in realtor fees, commissions, like all this other, like
Sure.
aren't those to blame? Like is it really the $5 FICO score that's causing it? So you have to look into like the reason for the sell off, of course. But I think FICO is a good one. I think Robinhood is a good one. Um, on the top of my head now, like
Those are two goodies. Now, I haven't been
yeah.
watching FICO very closely lately, but after this big sell-off, the stock price is down to around $1,200 a share. Sounds like these guys could consider a stock split potentially. It's always tough when these stocks get to those high prices,
Yeah,
but
you don't really get a lot of options traders when the stock is, $1,000.
for sure. But I mean, it's no, you can't deny the runs that these guys have been on, the Moody's and the FICOs and so on. These are wild moves. Robinhood's a great one. I
I
actually
think even
have a
Palantir is attractive here, actually, which is crazy to say
oh,
considering the general the general view on Palantir that it has been so excessively overvalued for so long. And that is typically based on, well, look at the price to sales or the price to earnings ratio. Well, yes, you can say that it is expensive based on those pricing metrics, but to say that it is overvalued, you would have to look at the next 10 to 15 years and look at what the value of that is. So I think with Palantir is that people are so obsessive about, oh, it is so overvalued. And I agree, like based on those metrics, it is extremely expensive. But the thing is, those are looking at the last 12 months or the next 12 months if you're looking at forward based pricing metrics. The thing with Palantir is that the margin expansion is just so immense, and the growth um, can probably continue for a very, very long time. And when you start to extrapolate that over a 10-year period, and then you discount that to today's value, it's not actually that overvalued, or even overvalued at all currently, I think. So at this time last year, my fair value for Palantir was around 70. For each passing quarter, we learned so much about the business and how strong the business is and what we can expect from the business over the coming periods, that my fair value for Palantir increased each passing quarter to now it's something like 190. So it has traded overvalued recently, when it was into 200, 210s and stuff like that. But each
sure.
passing quarter, I mean, this company just keeps showing us a trajectory that's really unprecedented. So to me, Palantir still, solid buy here. I don't mind, but yeah, there's a bunch. Those in particular. Now, when I'm put on the spot, I can't like recite every
Those,
opportunity, but those
those,
three.
those are
Let's go with those
those,
three.
yeah, no, those are great ones, and it is interesting how, obviously Palantir, um, the CEO is very has he's always very outspoken, and I think,
Yeah.
um, I would love to do like a study at some point and say, okay, how how outspoken or how quiet a CEO may or may not be, a founder, how does that affect the stock price, right? You have, um, uh, sort of, you sort of have a little bit of the opposite on like a Robinhood, right? You got Vlad Tenev, who's he's kind of been very quiet, but he's starting to kind of come out a lot more and make more appearances and so on, and getting more outspoken about the business. And so it's kind of interesting to kind of just look at that CEO side of things, because even though that doesn't necessarily affect the valuation, it affects the attention that people pay to these companies, right? And they start, oh, I like what this person's saying. Maybe I buy it, right? Because there's a lot of money that goes in on
Yeah, I
very
get
little
it. But
research.
yeah, sorry if I interrupted. I didn't mean to. Well, That's an interesting thought, but it kind of dies out quickly when you start to consider that you have someone like, the Salesforce CEO, Mark Benioff, talks a lot and the stock is completely, nuked. And he just keeps talking. But the thing is, the difference is that Benioff will sell you a grandiose dream and then, it's not materializing.
Sure.
Alex Karp talks and then puts up the numbers. Similarly with Vlad Tenev of Robinhood, like they will have a whole event to reveal a product, and it's not like during that event he says, "Oh, by the way, it is already available. Update your app." Like just executing. Like so,
Yeah.
there's a difference
Execution's a big
between
one.
being vocal and actually backing up what you're saying. Alex Karp, has been able to do it as of late, but there was a time, when he did appearances when the stock was, in the dumps. It's not that long ago. Like go back only like 2 years ago, and he did the same amount of appearances, but the stock was completely nuked. So I don't know if there's necessarily a correlation, but I think when you get that credibility of being able to put up the numbers. To how much you're talking, when you get a good ratio on that, that's when the stock tends to be rewarded, I guess. Do you have a lot
Yeah.
of
Yeah. No,
snake oil salesmen out there as well, like
for
Mark
sure. For
Benioff
sure.
or Tom Siebel of C3 AI? So you have these, it's a wide range of them.
Yeah. Yeah. These wild examples. No, it's a very interesting take, and typically, I think a lot of the retail investors out there, I mean, you take a very institutional kind of approach to this, which I think is very interesting. I think that's a great way to look at these companies, because right now we do see so much movement and so much volatility, and so often people don't know what to do, right? Things drop and you sell, things rise, and okay, maybe this is the next Nvidia and I better jump on at whatever price, and you end up on the wrong side of things so often. And so to kind of sit and do that research and then be patient for these kinds of moments, right, where there's great companies that are down 30, 40, 50% for no real good reason other than some panic, some uncertainty about somebody thinking that Anthropic is going to completely displace a $1 trillion software enterprise software company overnight, kind of a thing, right? And so I like that approach. I think that's a great way to look at these and take advantage of the opportunities. We always hear that it's we want to buy the dip, right? You want to buy the dip. That's the old infamous stock market slogan, but I think the reason that people panic in those moments is because they don't have the correct amount of information, right? This is a dip.
Yeah, yeah.
What does this mean, right? Does this company go to zero, or what? And I think that this is a great discussion and a great reminder that in the end, you do need to do the work. You need to dig in and you need to understand the companies that you own. And fund managers have been saying this forever. Remember, uh, is it Peter Lynch, the infamous Peter Lynch from
Yeah.
all those decades ago, right? The Magellan Fund, and he would say, I, I think people put more research into what refrigerator they buy in
Yeah.
their house than what stocks they own in their portfolio. They're literally what their retirement is depending on, and I think that still is
Yeah.
is a valid case.
Yeah, I think another quote from Lynch is that they will hear stock tip on the bus and they get out of breath, calling their brokerage to purchase that stock as soon as they get home. But the modern day equivalent of that is let's have a normal retail investor. They will hear their favorite YouTuber talk about the stock. They'll be like, "Oh my god, this sounds great. Let me go and buy that," and then the stock sells off. They're like, "Well, this guy better put out a video updating how I should feel about this, because I don't know." That's the biggest problem. So that's why I mentioned, like, I had 100% of my portfolio in one stock that I did the work on. I slept beautifully. Nowhere in the world I didn't care about it. I didn't check the stock price every day. That's because I did the work. I had the understanding of, okay, why do I own this, and why am I confident in that this will pan out, because I felt that I did so much work on the company where I understood it. I felt more than the market. Now, that's always very arrogant to say But at the time, that's how I felt. I slept well. But if I would have bought it, based on what a YouTuber told me or what a news article or a CNBC, short 3-minute coverage said about the stock, I would also be in panic. I'm like, well, I don't know exactly why I hold this. It sounded good at the time. I'm not really sure. Like, so I get, this sense of extreme fear and why people sell off companies, at these times, why it's so difficult to buy the dip, right? So I get that. And this is not only, retail, retail are not the ones moving prices down, 10, 15, 20%, intraday or, per week. This is like large institutions doing this. So it's not, limited to, the what people say dumb money. It's I think it's widespread. As we mentioned, with the Modran quote in the beginning, masquerading as caring about the growth, cash flows, and risk, but in reality, it's about mood, momentum. What is everyone else buying? So I think, that is permeated throughout, all sophistications of investors. It's not only retail doing this. I think institutions are equally guilty of it.
For sure, for sure. And I think there are some, different motivations in there, right? I mean, as a fund manager myself, it can be tough to sit through 1 or 2 or 3 months of drawdown. Investors want to see they want to see good news every month, and they don't care how they have to get it, right? And so you kind of have these different motivations on all sides of it. But you're right, there's a reason that the old saying of markets take the escalator up and the elevator down, right? And that that is very emotionally based for sure. So
So
that's excellent. These are
let
great
me
points
just
of view. Yeah.
I just have a quick question. So you're in the hedge fund business. So I heard a quote that your time horizon can only be as long as your least patient client. Is there some truth to that?
There certainly is truth to that. In the hedge fund space, there is a lot of positioning yourself correctly with the right investors. And if you're a longer term fund, your short term investors and LPs will wash out quickly. And so there is this pressure to constantly perform for your investors, but also you have to have the right investors, right? I'm not a overly short term fund, and so I can't really cater to that very short term type investor. And so and when you get the wrong people together, it usually doesn't last very long. But certainly, investors get impatient. People want returns. Nobody wants to sit through 3 months of, hey, negative performance. We've had to report this, because then brains start thinking, well, what do we have to make to come back to get to even? And so it starts this interesting cycle of what is really happening. And so, yeah, that psychology part of it is certainly an interesting one. And like I said, we've had guests on here that have automated strategies that are in and out of the market 500 times a day. And
Wild, yeah.
versus somebody like yourself who may be sitting in 4 positions right now, and writing it out for the next year, 2 years, 5 years. And so I just love these takes. But I think certainly the key takeaway today is do the work, right? And everybody has to find what connects to them. I can't short term trade. I'm too old. I'm too stressed out. It just doesn't work. And some people can't sit in things and watch drawdown happen and be okay with that. And it's such an interesting. It's so interesting to hear how everybody comes up with their ideas and how they manage and execute those ideas. And so you've got some great ones. Tell people where they can kind of follow your journey and find out more about what you're doing.
Yeah, so on Substack is where I publish, a majority of my equity research that is, publicly available. That is not, for some customer. So research.typefcapital.com. You will find all of my work there. I have a YouTube channel as well, and on X. But yeah, just go to the Substack. You'll find everything else. Don't worry.
Excellent, excellent. And we'll make sure to post that link along with this episode. But that is great stuff. Some really good takeaways. Thanks for spending some time with us today on the podcast. It was a pleasure having you, and I look forward to following your journey and having you on again down the road with us.
Yeah, thank you for having me.
Absolutely. Thanks again.